I'm speaking with Andrew Lockhart, Group CEO and Managing Partner at Metrics Credit Partners. Andrew, first of all, thank you very much for participating in the Inside Network's Income and Defensive Assets Symposium.
Yeah, thank you very much, James.
Great having you here. Andrew, what is it that makes private credit an attractive proposition in a higher rate environment?
I think the attraction for investors in private debt is primarily looking for two things. One is the stability of the capital, which comes from all of the protections that a lender can take. So the imposing of covenants, the controls, the taking of security, where you sit in the capital structure. So equity wears the risk. So the asset class can provide for protection of capital. On the other hand, it is also delivering a very attractive income. And so given most loans that are provided are based on a floating rate, as interest rates have risen, then obviously the total return to the investor has increased. But what we find is that in either markets when rates are going up or rates are coming down, the excess return, the spread that's been able to be generated in the asset class is very attractive in comparison to alternative assets.
How do you evaluate and manage borrower quality and borrower risk in private credit markets?
Everything is bottom up. So it's all deep fundamental credit analysis and skills. So myself, my partners and our team have had a long track record of lending money to different companies and providing financing. And so we're very familiar with understanding what industry structures are like, how businesses perform in different economic environments, what really drives the cash flow. And so our role is really to understand what drives the success and the performance of the business, understand what risks you might be exposed to in that business or that industry, and then make sure you're taking protective steps to mitigate that risk. And so as a lender, what you're looking to do is really understand the core drivers, the success of that business or the project that you're financing, and then to mitigate any downside risk so that that risk is really borne by shareholders and equity.
What safeguards do you use to manage liquidity risk?
Liquidity risk is really a function of the maturity profile of your underlying funds. So I'm a big advocate for private credit in investor portfolios. I believe it delivers stability of capital and an attractive source of income. The protections that are available in terms of the covenants, the controls, the taking of security is designed to protect investor capital. It becomes a very attractive asset class when you get exposure to a well-diversified portfolio. So when you've got a well-diversified portfolio with small exposures to any one individual counterparty, what you find is that you've got an increasing level of liquidity as borrowers are repaying their facilities on a regular basis. So there's a bit of a misconception that private debt is an illiquid asset class. It's an asset class that when you've got staggered maturity, so when you lend money to a company, it might be a loan for 12 months, 2 years, 3 or 5 years. So that staggered maturity profile across a well-diversified portfolio actually enhances investor liquidity.
How should advisors think about balancing public and private credit allocations?
Look, at the end of it, I don't think about it in the context of public or private markets. At the end of it, what investors are looking for is what's the risk that I'm exposed to? What is the return that can be generated? How does the asset class compare against alternatives? And what are the ways in which I can gain access to the asset class? And importantly, manage the liquidity of my investments. So as part of a broad, diversified portfolio of investments for an individual client, advisors are looking to structure those investments to deliver on the client's objectives. And usually those client objectives are, don't lose my money, preserve and protect my capital, and deliver me an acceptable return for that risk. So when I think about the world of private debt, I believe it's delivering a very attractive risk-adjusted return, and it's delivering very well in terms of the outcomes in client portfolios. At one end of the risk spectrum, private debt can actually be a very defensive asset allocation. At the other end of the spectrum, it might be an equity market replacement. So it's a very versatile asset class, but it requires a manager that's got skill set, a track record, scale, performance, and has delivered for investors. So when you think about investments, really what you're looking for is how do I maximize my return, removing any potential risk of downside, drawdown or loss, and how do I minimize or reduce my transaction costs? If you can invest in private debt and you can invest and lower your risk of potential loss, and you're also lowering your costs associated with the transaction costs or management fees associated with it, then obviously the net after fee and cost return to an investor is much greater. And that's what I think can be achieved in private debt investments.
Andrew, as you said, the Metrics team has had a lot of experience over many years. What kind of trends are you seeing emerging in the Australian private credit market?
I think that our business is primarily focused on our client outcomes. So we're focused on ensuring that our investors are getting a good return, that we're managing the risk effectively, and we're adhering to the obligations that we have to our investors. So I don't really look at what's happening across other competitors that are raising capital or looking to deploy. What I do think though is that the market will continue to consolidate into larger, more sophisticated managers that are delivering good outcomes for investors. So track record, the depth and skill set of the team, the ability to work through different economic cycles, all of those sorts of things are what attracts investors to a particular asset class and a particular manager's performance. So my guess is that over time there'll be a consolidation of the market as investors gravitate to managers and to funds that are larger, more scalable, more diversified, that are lowering their risk, delivering very attractive returns, but doing it for a very competitive cost base as well.
Andrew Lockhart from Metrics Credit Partners, thank you very much for your time today.
Thanks very much, James. Pleasure.